All right, my friends, so you have to invest in how you envision the world will be 10 years from now. Now, you gotta be careful because human nature, human beings are naturally pessimistic about the future, which is odd because we look fondly on the past and we look with trepidation on the future. Even if the past was chaotic, we still, because we survived, we look like, oh, it wasn't as bad as it wasn't that bad. In fact, it gave me lessons. Oh, it was good, actually. Long story short, I'm glad I went through that because here I am today. But while you were going through that in the past, you weren't thinking the same thing. I'm just telling you. And the problem with the future is you don't know what's going to be. So you're always thinking it's going to be worse because that's, human nature. It's a defensive mechanism. We're always, when you're walking by the Serengeti and you hear a bush, you're always thinking it's not the wind, it could be a lion jumping out to attack me. And that's just the defensive human being. So we're always pessimistic about the future, and yet, like I said, we look in the past with fondness, which is too bad, because what happens when you think about the future is that you make mistakes thinking that the future is going to be worse because that's your default premise. All right. So there's three ways to look at it. The future is going to be better, it's going to be worse, or it's going to be the same. One of those three things. All right, so if you were factoring those models, you say, I'm going to invest as if one of those three things. The future is better. That would inherently mean you should be in stocks, right? The future is worse. Well, you can argue that inherently, like a communist takeover. Then you should be in bonds? That doesn't make sense. I mean, the bonds aren't going to do you any better under communism as the stocks did. Now, I use communism in the worst case scenario. We'll talk about other mechanisms here, decline in stock market and things of that nature. But just hear me out. So if the future is better, you want to be in stocks. If the future is worse, we'll talk about that here in just a second. Table that for a second. If the future is the same, you'll still probably want to be in stocks just because earnings are growing year over year, and even the stocks don't give us immense returns, they're certainly going to be better, most likely, than bonds. That's for sure. So let's dive into what the future is worse looks like. All right, so if we have a 33, 33, 33 prediction of either of those scenarios, better, same, or worse, well, inherently, if it's better, you'll be in stocks. If it's the same, you should be in stocks. If it's worse, we can argue you might not want to be. And then you say, well, what is the argument if the future is worse? Well, in that case, you got to look at a communist takeover, then all economies coming to an end, including your bonds. You're doomed. All right, so what if it's not a communist takeover, was just a market decline? Well, yeah, stocks could be bad for sure. But if it's not a communist takeover, Bolshevik revolution, which seems more and more likely. I'm not going to lie to you. I'm not trying to dissuade you from that thinking. But it seems like every day, it seems like the left is becoming more and more emboldened with their insanity. All right, but what if it's not a communist revolution? It's just regulation, low growth, that kind of stuff. Almost like a deflationary Japanese environment. Well, you can make an argument that the Japanese environment, while the stock market has floundered for 20 years, the bond market hasn't done much either. That's a fact. So you can say, well, if you would have bought the Japanese 10-year Treasury bond in 2000, you got 6.5%, but then 2009, when it matured, you're getting less than 2%. Is that going to be a safe reprieve? I don't think so. Yes, you made 2%, and now you're getting negative interest rates, even though the inflation rate is basically zero. So look, I mean, that's what I'm trying to say. Is there's no safe place, because even in deflation, unless you're locking in 30-year bonds at 2.29 is what the Vanguard long-term bond index is doing, and of course 30-year treasuries are paying 1.3 right now, and I'm not going to make that recommendation at all. If you're going to be alive in 10 years, the long bonds aren't going to do it for you. The only thing that you have going for you is stocks. There's literally no other way around that. Now, you can argue cash, but cash, again, is good to the extent that you can spend it. It's not going to get you any growth. It'll keep you, even where you are relative to, if we don't have any inflation. But if you have any kind of inflation, your cash, because it's not paying anything, you're losing. Then you got to pay tax on the interest you make. So if you don't have any inflation, cash is not a bad thing. But what's the likelihood of no inflation? If you look at Japan model, they even had a little bit of inflation, not much, but even that. So I don't think cash is good for 10 years. I think at the end of the day, you have to say to yourself, 10 years from now, the likelihood of the stock market being higher is good. The likelihood of the stock market being lower is not as good for sure, but it could be, absolutely. But if we are in a scenario that we are in now, it's just, we got up, we got down, we got, middling. Middling is better for stocks. Up is better for stocks. Down is worse for stocks, but it's also bad for bonds. And then cash would be king, sure, but seems to me that the odds are weighted against in that regard. And that's the way I look at it. 10 years from now, if the Bolsheviks don't take over, stocks will probably be better than bonds. Will certainly be better than bonds, but will probably even be better than cash. That's how you got to look at it. Now, for your short-term stuff, the money you need to pay your mortgage, no, you don't look at it like that. But I think you have to invest with a 10-year time frame, and that 10-year time frame would say you're just going to have to gamble. And I think it's a well-played gamble that stocks are going to be better than bonds and cash in over 10 years. And I think if you don't invest that way, you'll make a tragic mistake of saying, well, I missed out on 10 years of potential growth. That's the way I look at it. Now, people would make the argument, yeah, but Josh, bonds outperform stocks here, bonds outperform stocks there. I get that. But, bonds were never the interest rates that they are now. They just weren't. Even in the Great Depression, the bonds were still paying 3. During the 1982, 10-year treasuries paying 15, 18. I know a 30-year treasury is paying 15 and a quarter in 1982. It's not doing that anymore. It's paying 1.3. So anyway, that's the way I look at stock investing. I say 10 years from now, I think I'll be glad I stayed the course, and I don't think there's any alternative for my long-term investments. And that's the way you should look at it too, in my opinion. I will see you.